All right, welcome to another business intelligence show where we're going to be discussing the details about macro, on-chain, and also monetary mechanics. And I'm joined by Alex. How you doing today?
I'm feeling wonderful. I'm really looking forward to discuss the report today. We got
All
some
right,
interesting stuff as always.
yeah. Now we heard a feedback, so a much better mic this time. So hope you guys can hear him better. So all right. So whatever we're gonna discuss today is part of our BI 26 report. And if you want to have access to that, actually, I have great news for you because so here. So the Fed just caved. Got any Bitcoin? So this report from now on, any client, any subscriber, any free subscriber is going to be able to access it also for free. So we do have a 2-week trial where you can have access to our report in full. So take advantage of that. Links are on the description below. So let's dive right in. Alex, so you're a professional there, especially on the on-chain part. Of course, you can talk a little bit about macro as well. But what caught mostly your attention this week from the report, so we can kind of discuss and go from there?
So what I found most interesting is the macro section of the report because what we find is that the Fed is actually failing on its dual mandate. As you probably know, the Fed has the dual mandate of making sure the unemployment is low or employment is high, the way of saying it, and also that inflation is not out of control. We saw from the previous report, the BI 25, that even though the CPI is hovering, above 2% or so, the PPI, the producer price index, is a lot worse, and we have a 3-year all-time high on the PPI side of things. So what that means is that we've got inflationary problems, of course, but at the same time, the unemployment is also high. So it's one of the key reasons why I believe the Fed has decided to lower the base interest rate, believing that this is going to be, beneficial in terms of reclaiming those job losses. In fact, in the report, we've got a graph showing if you scroll down a little bit, the overall, payroll data and the net losses that we've seen recently, and it's just highlighting, I think, that the overall challenge with the prevailing Keynesian economic model that the Fed is following, because basically we just see another example of the Keynesian economics being invalidated, because we see an example of high inflation and high unemployment, which shouldn't be the case if the Keynesian model is true. But I suppose we can leave that for a discussion for a different session altogether.
Yeah, for sure. No, totally agree with you. So it's pretty hard to get the Fed. I talk a lot about that in our macro, in our monetary mechanics session as well. That I mean, we do have a fiscal dominance here. So basically, there's no way just by cutting rates or just trying to adjust the economy just through interest rates. That just does not work when you have a fiscal stimulus. And basically, I would even believe that even though everybody expects for rate cuts, once the cuts actually happen, you might see the 10-year yield just go up. And people normally don't understand why that happens. It's because the bond market doesn't react the way people think. So the bond market is really a worldwide market and not really the US. But good catch there. And now, do you want to jump to on chain? So we discuss a little bit about that as well.
Yeah, I mean, there's a couple of bullet points here. So anyone interested, I would encourage to see the report. But I would mention that basically we see that the price is kind of hovering below the cost basis for the top buyers in this report. So again, that begs the question: is it something that is going to further accelerate? Result in short-term downwards price fluctuation, or is it going to go up? I think we've seen from the on-chain analysis also that the kind of leveraged buyers are kind of pushing the price upwards. So it's not kind of sinking, it's not making the price sink down too much. So I would say these are the kind of two interesting highlights from this section of our report.
For sure. For sure. So everything here related to liquidation heat map. So this is a very, very complete report that we have right now. So now back to maybe a little bit of macro as well on the monetary mechanics side. So just a few updates from the report itself. Basically, we are tracking very specific parts and what comes to liquidity, because liquidity drives pricing, liquidity drives risk on assets. And one of the things here that we are continue to see, which is still catching our attention, is DXY. So basically the dollar index comparing the dollar to the other currencies. Even though most people in the Bitcoin space say, look, why do I care about a fiat to fiat relationship? But this drives absolutely everything for you to understand how liquidity is driven, especially outside of the United States. And we still see on the longer term, you see how it's actually going down, even though from July until today, we still have maybe a reversal, but not yet confirmed. So we're still gonna have a look. But this means basically dollars are more plentiful, dollars are more available to service the current debt that was already taking. So this is able to provide a lot of the liquidity that we're seeing. So S&P at all-time highs. We see Bitcoin still on almost, despite the recent corrections, still close to all-time highs. We see gold today at all-time highs. We see China, the Chinese market also going up. We see Europe going up. So everywhere you do see a lot of liquidity. So this drives a lot of the risk on process here, and we're going to still keep track on it. So it's hard to be bearish, even though despite of what Alex just talked about what happens in the U.S. So that's how the real economy has absolutely nothing to do with the financial markets. These are two completely unrelated events. They should be more related, of course, but it's not what we currently have. So our monetary system works on that matter. This is why whoever has assets is able to get by, but whoever just has an income just gets diluted over time of these forces. Anything you want to might add to it, or anything that spring to your mind, Alex, about that? Or
well, I mean, if you are listening and you are one of the people who are entirely relying on an income stream, you should probably think about buying assets like Bitcoin to protect yourself against this debasement that is necessarily ingrained into our system, because that's the only way we are able to service the debt and also make the entire system whole. So get yourself some Bitcoin, as
sure.
we say always.
Yeah, that's one of the easiest ways to say it, for sure. And here on the monetary mechanics, you also see how, even though we might have corrections or a lot of maybe uncertainty in the short term, you see how those kinds of posts, for example, show that even if it goes down, you're going to see support. Unfortunately, it's all about the image created by an administration. So, for example, Trump does not want on his watch for the markets to go down, so him to be remembered as a bad president, so to speak. It doesn't really matter what you think about him or not, but this is exactly the kind of support that you're going to see more and more to the market. So liquidity is actually going to be injected, if we like it or not. Also, the pressure onto the Fed just keeps going. So we see how the whole ordeal with Lisa Cook from the Fed, and how you see more and more movements of maybe a fusion, maybe a full control. Nobody knows exactly what's going to happen, but the Fed is under a lot of pressure, and of course, it's very clear that the administration wants to have everything under the same roof to really go full MMT, so to speak, where you have control of fiscal and also monetary policies at the same time. Will they actually going to do it? So time will tell. But for sure, it's one of the intentions, and this is very liquidity positive. Uh, on the other hand, another uh, pillar of monetary liquidity worldwide is China. So China is still dealing with a lot of struggle on domestic consumption. So you have a lot of pressures from exporters who need to actually bring products to the domestic market that weren't supposed to be that because of the whole tariff situation and transshipment to other countries. So they're really trying to get by, and this drives prices down. So you create a deflationary spiral onto goods, which can be seen as a good thing if you're a Chinese trying to pay for things, and prices actually are coming down for many products. But it also creates a lot of liquidity into the domestic consumption. So this is one of the policies that China really defined. They really want to work towards that, and you're also going to see on our next report next week on how that actually creates some pressure, some internal pressure into Chinese stocks. Even though foreigners are getting money out of the country, you see Chinese stocks just going up and up. And this is a very interesting scenario because that's very liquidity positive, and it's also making the 10-year yield in China kind of reverse a little bit. So we were seeing it just go down and without any signs of stopping, and that might be we might be on a reversal. But everything we just discussed, still very liquidity positive as well. But again, for our outlook and biases, if you want to understand exactly how you can actually use that information to have actionable results into your investments, make sure to have access to this report. And again, you can have access to it completely for free on a 2-week trial for our subscription. So any final words that you would like to say, Alex? So before we wrap up.
No, I mean, stay humble and stack sats. That's how I would conclude.
Got it. No worries. All right, guys. So this was a BI 26 report. And next week, we're going to have a lot of stuff to talk about on our BI 27. All right. So see you guys on the next video.
Cheers, guys. See you soon.